Welcome to today's video where we bust a common mortgage myth. A high appraisal at closing does not cancel FHA mortgage insurance premium, known as MIP. We will explore why FHA rules are stricter than conventional PMI, how loan-to-value is calculated, and what your true exit strategy looks like. Let's begin. Here is our agenda. First, we define the myth. Then, we compare FHA MIP to conventional PMI. Next, we explain why high appraisals don't cancel MIP and clarify the real loan-to-value calculation. After that, we cover the only reliable exit strategy, refinancing, and how to weigh costs and timing. We will include short quizzes and finish with key takeaways and a disclaimer. The myth claims that if your home appraises higher than the purchase price at closing, you instantly have more equity and can avoid or remove mortgage insurance. While this may influence some conventional scenarios down the road, it does not cancel FHA MIP. Let's unpack why. First, terminology matters. FHA loans have MIP, not PMI. Conventional loans have PMI. These are different programs with different rules. FHA's MIP rules are stricter. And in many cases, MIP will remain for the life of the loan if your down payment is less than 10%. Conventional PMI has built-in cancellation mechanisms, such as automatic cancellation at 78% loan-to-value and borrower-initiated cancellation at 80%, subject to conditions. On the left, FHA MIP applies to FHA loans and, with less than 10% down, is permanent for the life of the loan. With 10% or more down, MIP often cancels after 11 years. It is governed by FHA rules and does not respond to later equity gains for removal. On the right, conventional PMI applies to conventional loans when the initial loan-to-value exceeds 80%. It can be requested to be removed at 80% loan-to-value and is automatically canceled at 78% per the amortization schedule, subject to investor guidelines. A higher appraisal post-closing can help remove PMI on conventional loans, but does not remove FHA MIP. FHA's loan-to-value is calculated using the lower of the purchase price or the appraised value at the time of closing. If the appraisal is higher than the purchase price, FHA still uses the purchase price for calculating LTV. As a result, the higher appraisal does not increase your official starting equity for MIP rules, and it does not cancel MIP. Lenders are correct when they state that MIP stays because FHA rules mandate it based on initial LTV and contract price rather than subsequent equity growth. This flowchart visualizes FHA MIP duration rules. We begin by checking the down payment percentage. If the borrower puts down less than 10%, which corresponds to an initial loan-to-value above 90%, the mortgage insurance premium lasts for the life of the loan. If the borrower puts down 10% or more, corresponding to an initial loan-to-value of 90% or less, the MIP typically lasts 11 years. The diagram also emphasizes that a high appraisal at closing does not alter the initial LTV for FHA, and that future equity gains do not trigger automatic cancellation. The only path shown to remove MIP is refinancing into a conventional loan. Quiz time. Question: with an FHA loan and 3.5% down, will a high appraisal at closing cancel your mortgage insurance? Options: A. Yes, because you have instant 20% equity. B. No, because FHA MIP is based on initial loan-to-value using the lower of price or appraisal. C. Yes, if the appraisal is 10% higher than the purchase price. D. Maybe, depending on the lender's discretion. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. FHA uses the lower of the purchase price or appraised value to determine initial loan-to-value, and with less than 10% down, mortgage insurance premium is permanent. A higher appraisal at closing does not cancel FHA MIP. Here is a practical roadmap to remove FHA MIP by refinancing. First, wait 6 to 12 months to build payment history and allow the property value to season. Next, monitor interest rates and your home's market value. Then, run numbers to target an 80% loan-to-value or lower on a conventional refinance to avoid PMI entirely. Get pre-qualified and compare lenders. Order a new appraisal as part of the refinance. Evaluate closing costs, your new interest rates, and monthly savings from removing MIP to determine your break-even month. If the numbers align, proceed with the conventional refinance. This timeline outlines the typical sequence from closing your FHA loan through a potential refinance. At month 0, you close on the FHA loan. Months 1 through 6 focus on establishing payment history. From months 3 to 12, you track interest rates and market trends. Between months 5 and 12, you begin pre-qualification and collect lender quotes. Around months 6 to 12, you complete appraisal and underwriting. Finally, your refinance closing may occur any time after the 6 to 12-month window, depending on eligibility and economics. To determine whether the refinance makes sense, estimate your monthly savings from removing MIP and potentially securing a lower rate. Compare your new interest rate to the current rate and include closing costs to calculate your break-even month. Consider whether resetting the loan term affects total interest paid. Make sure you include escrow adjustments, taxes, insurance, and any discount points in your cost analysis. Here is a simple illustration. Suppose the current FHA rate is 6.75%, with a loan amount of $350,000 and a monthly MIP of $200. The proposed conventional refinance might be 6.25% with a loan amount of $340,000, 0 monthly PMI if at or below 80% loan to value, and about $5,000 in closing costs. If the total monthly savings are approximately $275, the break-even point would be around 18 months. Actual numbers will vary by market, credit profile, and lender fees. Second quiz. For FHA loan-to-value calculations at closing, which value is used? Options. A. Always the appraised value. B. The higher of purchase price or appraised value. C. The lower of purchase price or appraised value. D. Always the purchase price regardless of appraisal. You may pause the video now to think about the answer. Deal 2. We will discuss the answer in the next section of the video. The correct answer is C. FHA uses the lower of the purchase price or the appraised value at closing for LTV, which is why a higher appraisal at closing does not increase the official starting equity for MIP purposes. Here are common pitfalls. Instant 20% equity does not cancel FHA mortgage insurance premium. Lenders cannot waive FHA MIP because the rules are set by FHA. A new appraisal immediately after closing does not cancel FHA MIP. PMI and MIP are not the same. They belong to different programs with different removal rules. Finally, do not assume an immediate refinance is best. Consider seasoning requirements, costs, and your break-even timing. These are the key points. FHA loans have MIP, conventional loans have PMI, and the rules are not interchangeable. With less than 10% down on FHA, MIP is permanent. High appraisals at closing do not cancel MIP. Loan-to-value is calculated using the lower of purchase price or appraised value. To remove MIP, refinance into a conventional loan at or below 80% loan-to-value. Always run a cost and benefit analysis before refinancing. This mind map organizes the relationships between equity and mortgage insurance. The FHA branch explains MIP's duration and that it is not canceled by a high appraisal. The conventional branch explains PMI removal requests at 80% loan-to-value and automatic cancellation at 78%. The refinance branch shows the steps and considerations including appraisal, costs, break-even calculation, rate comparison, and the target of at or below 80% loan-to-value. To recap, identify whether you have FHA MIP or conventional PMI. Understand that FHA calculates LTV using the lower of purchase price or appraised value. If your FHA down payment was less than 10%, expect MIP to remain for the life of the loan. Plan your exit by refinancing to a conventional loan once your loan-to-value is at or below 80%, and consider doing so after 6 to 12 months while running the cost analysis. Disclaimer: this content is educational and not financial, legal, or tax advice. Guidelines and investor overlays can change, so verify current FHA and conventional rules. Your rates, fees, and eligibility depend on your financial profile and market conditions. Consult licensed professionals before making mortgage decisions. Thank you for watching. If this myth busting was helpful, please like, share with a friend, and subscribe for more content. Leave your questions or experiences in the comments so we can continue the conversation.